Major funding for this program is made possible by grants from HSH Nordbank New York Branch and First American Title Insurance Company of New York, Perfect Building Maintenance, Greenberg Traurig LP, the Moynihan Group. Additional funding for this program is made possible by grants from Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, Cushman & Wakefield, Fremont Investment and Loan, Massey Knackle Realty Services, Muss Development LLC, Rosenthal & Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Wickoff Group, Titan Capital, YL Real Estate Developers.
Welcome to the Stoller Report. My name is Michael Stoller. Investment sales. Everybody's buying. Everybody loves New York City. Everybody wants to own something in New York City. I don't know who's buying, but I know who's selling. I got the guys who really sell everything in New York. They are the gurus. They are the kings of New York City real estate. Today my guests include Woody Heller, Executive Managing Director at Studley; Robert Knackle, otherwise known as Bob, Chairman of Massey Knackle Realty Services; and last but not least, John Kaplan, Executive Director of Cushman & Wakefield. So, John, just before we started the show, you said, where did I get this number, 31 billion or 35 billion? How much was really transacted last year?
Well, we track sales, and we track sales that are above $10 million, the $10 million level, and last year our numbers show about $35 billion in investment sales in New York City, which compares to the prior year's record volume of 21 billion, just to give you an idea of the growth.
35 billion, and it doesn't even include everything that Bob sold over 500 properties and different things. So maybe we're really closer to $40 billion, right?
Very well
$40 billion. So Woody, where is this money coming from? Who's investing?
The interesting thing about it is money comes from different places, but generally all over the world. And the reason why New York is such an interesting market and so many people want to invest here is because it's an interesting market and so many people want to invest here. So you always know you're going to be able to sell if you buy here because it's one of the most popular markets in the world and has the highest liquidity.
And Bobby, who's buying? I mean, you represent only sellers. You represent mostly sellers, or I say 95% of your clients. Who's buying? Who are the buyers who come to you?
Well, most of the people who are buying today, Michael, are people who have existing portfolios of properties, and they're either trying to add to their portfolio, upgrade the portfolio, trade up from Class B or C properties to Class A properties, or from the boroughs into Manhattan. And we're seeing tremendous investment from foreign buyers. We have a very unusual circumstance worldwide today where almost every economy is growing. And people in other countries are making money. They want to invest that money someplace where it's safe and they believe they'll get a good return. And New York is the place to do that. So we've seen demand coming from just about every segment, domestically and internationally.
You know, a couple of months ago, you had about 600 people sitting in the Grand Hyatt Hotel, and you ran this great breakfast presentation, and you said, you remember cycle, 13 years. How many years longer can this stand?
Well, we believe it'll be at least 2 more years because everything at the moment is full of certainty. And uncertainty is the thing the market doesn't like. And the midterm elections that just passed produced no surprises. We don't anticipate any legislative changes that could really negatively impact the market. So really through the end of 2008, we think the market is going to continue to chug along at a steady pace, and there's really nothing on the horizon that says the fate of the market is going to be any different than it is right now.
I mean, the market, Woody.
Well, just to your point, Bob, with respect to uncertainty, we've just had our 5th Fed meeting where there's been no change in the rates. Interest rates all of last year is one of the greatest things that was feared in a market that's otherwise been quite sanguine. And despite the fact that cap rates kept falling while rates were going up, so it wasn't something which people really should have been afraid of, But now it's nothing to even think about because rates have been steady, and the expectation is the Fed is going to wait out the economy and see what happens for a good period of time. So another potential area of uncertainty, not an issue.
So, it's like the favorite flavor of ice cream, they say, is vanilla. So what's the favorite flavor of real estate today by investors? Is it residential? Is it hotels? Is it apartments? Or is it land? What do you say? What do you think? What's that flavor of the month, or the flavor of 2007?
I think it's rainbow. And by that I mean there are so many...
Is that like Spumoni, combination?
It depends where you come from. I think the answer is that there are very few segments of the market today that are not extremely popular. And that's what's perhaps causing this enormous transaction volume, is that there's so much activity in so many sectors of the market. The only sector of the market where we see the enthusiasm ebbing slightly has been the condo market, either site sales to build new construction for condominium development or the sale of existing buildings of varietal nature to conversion to condos. Otherwise, the market is on fire in virtually all sectors.
You concur with him on this condo discussion?
Well, I agree with what Woody said. I'd like to add to it, though.
Don't always agree with Woody.
I think I rarely agree with him. No, I usually do. But I believe that the rent-regulated housing market is probably the hottest market out there today.
A small complex was sold last year, rent-regulated. $5.4 billion, Stuyvesant down?
Yeah, I read something about that. But I think the reason why that type of product is in such high demand is because the risk premium is almost non-existent.
What do you mean by the risk premium, Bob?
Well, with respect to a fully passive, fully guaranteed government yield, the risk that normally is associated with purchasing real estate doesn't exist today. That's why cap rates are so low. So you see a lot of multifamily buildings with high percentages of rent-regulated apartments trading at cap rates below what government yields would be. So there's no risk associated with real estate investment in general, but particularly for those buildings, the risk premium is non-existent.
So you're saying that we got these guys from Dubai who are going to come here and they're going to go to Washington Heights, or they're going to go into Bed-Stuy, and they're going to buy some apartments, are they?
We haven't seen that yet.
No, the guys from Dubai will not go and directly make investment in that market, but what they will do is provide equity financing for somebody that knows how to run the properties, because the rent-regulated system here is very complicated. So in the office building market, as Woody and John will tell you, you see very transparent investment on behalf of foreign investors that are buying big office buildings or hotels. But in the rent-regulated world, you don't see that. But what you're not seeing is the amount of capital that's being deployed by the international market through equity financing of local operators.
John, you said before the show that there was a site that you guys sold for $775 a square foot. I think that's probably, from what I can recognize, one of the highest prices around in the last couple of years. I mean, $790 may have been for the Mayflower, but everything. $775. Who's buying a site for $770? And this is not, a little site to put condominiums. Who's buying this type of site?
Well, this site is under contract. It's a site next to the MoMA Museum, and it's between 53rd and 54th Streets, just west of the museum itself, and it's under contract to Hines.
Now, so Hines is going to build an office building on this?
Actually, that remains to be determined. That is a possibility, and we had folks looking at the site with different visions that included office, hotel, and luxury residential, and several talking about it in terms of a mixed-use development.
So Woody, if we look at his situation for $700, and I think it relates to your comment, Bob, if somebody's going to pay $775 for the dirt, as one we would call, and you can buy a building on 42nd Street from you for maybe $600 for a building and the dirt, isn't it better to buy an established asset?
Depends what you want to do. An established asset doesn't always have the attributes that a new asset would have. So there's the opportunity to create something different and quite unusual here. I think that anybody who's paying that price is probably going to attempt to put some type of a combination of uses together in a synergistic way to increase the value of the component parts.
Now, you sold the site a couple of months ago, the New York Law School site. What are they building on that? I mean, here's a nonprofit, which is a good example because Bob just sold a number of nonprofit sites for hospitals. What do you see? What are they going to do with it? Just cash in, take the money, and run?
Right. Well, so that was sold by a not-for-profit to clearly a very profit-oriented enterprise.
You represented the seller.
Of course, of an equity investor and a developer, and they're going to build condominiums. So that's a deal that was done at a time in the market when the condo market has relaxed somewhat. But it's such an extraordinary site and such an unusual opportunity to build something that's distinct, highly unusual, and not permissible elsewhere in a market which is still very strong in the city for condos. And so that was a project where the developers and the investors felt confident to go forward in spite of the fact that the market was changing somewhat.
And what do you see happening with that? I mean, you're selling sites all over the city. I mean, this was a nonprofit, but who was a healthy nonprofit, as we would say.
They are now. They weren't then.
They were reasonable. I mean, they're not like St. Vincent's, where it's a Catholic medical center that is in bankruptcy, who needs the money. I mean, some of these places, nonprofits, you know, like the ADL, so they're building for $100 million. Now they can set up an endowment. Basically, the similar concept you see. What do you see with nonprofits? You see more of them selling, Bobby?
Well, more of them are certainly looking at their options because the prices are so compelling today that's very difficult for an organization that may be in financial difficulty to not take advantage of their real estate value. So more and more they're looking at what their options are. Some are indeed capitalizing on the opportunity that exists today. And the biggest problem that they have is what to do after they've sold the property in terms of relocation opportunities.
You know, a couple of years ago, yes, well,
Can I stay on this point? Because I think what we're seeing in all these not-for-profit situations is that the not-for-profit can't go out of operation, right? So you don't get the chance to represent them typically and just sell what they have and they say, thanks very much, we'll take the money and we'll see you. In order to make these deals come to pass, as was our example of New York Law School and several of the others that we've all done, you've got to find a new home for them, and that's got to be part of the path of the project. So in our particular situation, we had a 50,000 square foot site. We sold 12,500 square feet of it. We took the XX air rights from the balance of the site, transferred them to the 12.5, and the proceeds of that sale enabled us to build a new facility on the balance of the square footage, of the balance of the footprint.
Yeah, we worked on a couple of situations where we were able to sell a site, but arrange for, you know, through a development agreement to provide facilities to the seller.
right. I mean, you sold it hasn't closed yet. You sold the American Cancer site on East. It's 56th Street between 5th and 6th Avenue, and American Cancer is moving their headquarters and opening up a Hope Lodge in the Epic, which is a Douglas Durst, Franciscan Friars, and Hal Fethner deal.
Yeah, and in the case of Beekman Hospital, we arranged for a ambulatory care facility and parking to be provided in the development that is being built by Forest City Ratner. In the situation with MoMA, there will actually be, in the new development on the site next to their museum, which is under contract, there will be 3 or 4 floors for expansion of the museum in the new development.
Yeah, but that also allows someone to get additional bulkage, okay, because of the community facility space in many aspects of the situation. Now, what about the outer boroughs? You know, everybody, as you said, wants to be in New York, investors from around the world. What about, you know, there's been a lot of discussion about Williamsburg. Okay, you know, they rezoned Williamsburg. Toll Brothers is building, Levine Douglaston Development is building, George Klein is building. Do you see Williamsburg growing as well as it was, Rob?
Yeah, we think Williamsburg is a fantastic, very exciting marketplace. And when we have candidates coming to interview at our firm from outside the New York metropolitan area that want to come work in New York, the number one place they want to work and live is Manhattan, but very close behind that is Brooklyn. And we're amazed that people will come in from Atlanta or Minnesota or Denver and want to live in Brooklyn. But Brooklyn is very, very highly sought after today, and we think the developments that are currently in the ground are going to be very, very successful.
What do you think about Coney Island, since you're speaking about Brooklyn?
Well, I think Coney Island is fantastic. I think Coney Island used to be a hub of commercial activity in Brooklyn and kind of lost its prominence for a while, but based upon the projects that are currently planned and are to be planned, we think that Coney Island will regain that prominence and really be a very exciting hub of activity in that area.
So you see investment opportunities in Coney Island. You know, about 2 years ago, Woody, you were on the show, and we had you helped me bring a great group of people together, and I said Long Island City. And when I mentioned Long Island City, I think everyone sat there and said, "Nah, I don't want to have an office building there. I don't like Long Island City." What do you see happening today in Long Island City?
Well, I think I want to make a more general point, if I can.
You can always make a point. You know.
Thank you. Following on what
He's
Bob was
so,
saying.
you know,
I know.
nice.
You love when I reword your questions. But I think it's interesting to think about the outer boroughs and what's been happening recently, because, you know, suddenly we find ourselves speaking a lot about the outer boroughs, and we find the outer boroughs being very active in all of our activities in a way that wasn't the case a couple of years ago. And I think it's interesting just to sort of focus for a second on why that's happening. And I think it's a function of two things. One is, obviously, as the primary markets become more expensive, people look for less expensive alternatives. But that in and of itself isn't what's driving the situation. The other half of the equation is that the residential market has become so incredibly popular. And all of us spend, certainly for John and I, but it's been more, I think, a part of Bob's practice for a longer period of time. But John and I spend an inordinate amount of our time probably involved in residential today, whereas 3, 4, 5 years ago, that was probably considerably less so the case. So when you have residential, and as Bob says, regulated residential, now such a popular part of the investment marketplace, that pulls the outer boroughs very much into focus for a lot of investors. And about a year and a half ago, we were invited to participate in a project in the outer boroughs, with rent-regulated properties, which was one of the earlier projects we'd worked on. And we thought, okay, if we can take properties that generally are bought in one-off situations, put them together into a large package, and analyze them the way some of the institutional purchasers to whom we typically sell look at them, maybe we can get a different buying audience to go there. And what we found is that not only was that the case, but we were astounded by the amount of institutional capital that's so starved to find an alternative that they're looking for in different places to try to find investment opportunities. So now you find in all these various different markets, all the usual suspects actively trying to buy there in a way that a year or two ago was not the case.
Are you saying to me that all the usual suspects are looking to buy in Long Island City, in Williamsburg, in the South Bronx?
Yes. Many of them are. And what's happening in the city is very exciting on the residential side, because retirees want to come back to the city, empty nesters want to come back, and college grads and young professionals
I realize
love
that certain
being here.
baby boomers were born on the Grand Concourse. I don't think they're coming back to the Grand Concourse. They may be coming to other places.
But certainly, you know, the city's projecting that the population, which is around now 8 million, will be 9 million in 2030, and it's anticipated that 500,000 additional housing units are going to be needed. So definitely the Bronx, Brooklyn, and Queens will be beneficiaries of this. And you know, also on the commercial side, we're seeing, you know, a tremendous market which supports this, because if you look at the office sector and the hotel sector, the commercial side of the New York economy is extremely strong. And there's also so little space that, you know, we're getting a crunch there too.
Yeah, we're seeing that very much so in the multifamily market across the entire city, even in areas that would not traditionally be institutional grade locations, Flatbush, Bed-Stuy, South Bronx. Today, because of the magnitude of deals, even families that have significant holdings are generally doing transactions with institutional money behind them. And this institutional money is loving this product type because there are about 2 million regulated housing units in New York City. Those people have to live somewhere. They pay their rent. There's bustling commerce in these different neighborhoods. And rent-regulated housing is looked on as an extraordinarily safe investment, regardless of the location.
Are land prices going down? Do you see 2007 a year that prices for land, with the exception of the MoMA site, dropping?
Well, I think the answer is possibly, depending upon for what use, but I think the MoMA site's a sort of an interesting example you can't put aside. Right, you mentioned it's one of the highest prices paid.
Location.
I think secondary and tertiary locations are going to be hit. They have been for about 4 or 5 months, and they probably will continue.
And what's the reason for this?
Well, because the end user condominium market is uncertain at the moment. And that is probably the biggest variable that we have going forward in terms of the performance of the market, is how the consumer condominium market is going to behave.
Well, the other point that we've discussed before among ourselves is the absence of the 421A program. So that's going to take some value off sites in general that are sort of slated for that type of use. But the other thing that I think is sort of interesting to focus on is that when the residential market was extremely strong, what we saw is, as Bob was saying, sort of secondary and tertiary sites were sold at very high prices, and the price distinction between primary sites and non-primary sites was very small. And what that further says was that developers and lenders were willing to take zoning risk and possession risk because the market was so strong and increasing so rapidly. The feeling was, okay, even if I pay a big price today, the market's going up, I'll be saved. I just want to be in the game, and I'll do whatever I need to in order to make that happen. Today, now that there's not the perception that the market is rising at the pace that it previously was, people are more pensive. And so I think the distinction between primary and secondary markets is now being made in the market where it wasn't before. And I think that buyers are less willing to take entitlement and zoning risk to the same degree that they were before. And so that's impacting the change in pricing.
Lower Manhattan.
Great. But go ahead, John.
I agree. It's a Lower Manhattan.
Everyone
It's
everyone could have said Ken Swig was either the smartest guy or the stupidest guy. And it looks like that my friend Ken Swig was a very bright guy because he's made a major investment in Lower Manhattan. He owns close to 5 million square feet.
Well, it's interesting. If you look at office development over the past few decades, from the 1960s through the 1980s, new office development ranged between 55 and 65 million square feet a decade. In the 1990s, it was around 12 to 13 million square feet, and it's projected that the current decade is going to be about 17 million square feet. There's almost no speculative development, and we're in a serious shortage of office space right now. So Midtown's extremely tight. There's maybe 3 blocks of space in all of Midtown above 250,000 square feet that are available. And there's also a very tight market, Midtown South and downtown. So downtown is definitely the beneficiary of this. But longer term, you've got much more of a residential housing stock in downtown, and that continues to grow. We've been under retail downtown, but we're seeing that changing now as well. So longer term, downtown also has excellent prospects because it will be more of a 24/7 location and won't be as dependent on the Midtown market.
If I can follow on to your point, John, two things that I think are interesting. One is that Midtown, generally speaking, is a market which, with exceptions, has always been a good market in which to invest. And I think downtown is a market where people have made an enormous amount of money, but the timing of when they bought and when they sold needed to be more carefully thought through. Number one. Number two, downtown obviously went through some hard times of late, and I think the perception is that those challenges that it faced are behind it. Tenants are moving down. Seven World Trade has been unbelievably successful, not just in leasing, not just in attracting strong, good credit, high-profile tenants, but large tenants at unprecedented prices. So for downtown to be making those rental achievements and drawing tenants the way that it is, to some extent because the market is space constrained, but also because it's now a market that people are comfortable moving back into, it says to investors that this is where they want to go. And then I'll stop. When investors come to us and say, where are the opportunities to invest in New York? Everything is so expensive. If you don't want to go to a secondary or tertiary market, but you want to try to stay local, downtown is consistently where investors today are looking to put money because they think that's where the opportunities are going to be.
And you have to mention also the infrastructure with respect to transportation. That's changing the whole dynamic down there.
Harlem.
Heard of it?
Heard of it?
Yeah. I mean, Harlem is fascinating, I think, because there's been I think that people's general perceptions of the marketplace are lag wildly behind the reality of what's going on there. So it used to be that people were beginning to invest or beginning to think about it. Harlem is now a very mainstream market.
But most of the investment, Woody, in Harlem has been residential.
Without question.
With the exception of Vornado with McFarland Partners and Integrated Holdings deal on 125th Street, which no one would get zoned today, which is a 540,000 square foot building. You're not going to see office developments in Harlem. The community in Harlem wants a downzone. Harlem. They want to reduce the size of it. There was a project on 127th and 2nd Avenue, which Gotham was going to do, and then they got downzone. I mean, Harlem is good, but as I've said in my articles and publicly, there are 3 Harlems, and each one, and I know you guys have such a great pulse on it, that East Harlem is totally different than West and Central Harlem. I mean, there is no question. And I think the retail, what's really lacking and which really can do well in Harlem is additional retail.
No doubt about it, Michael.
Retail in Harlem is unbelievable. I think the success of Harlem USA has been fantastic. And I mean, look at the retail today in the Bronx. Out of nowhere, all of these new developments, mostly by the related companies, have been built in the Bronx. The Bronx is really doing well.
Well, it makes a lot of sense. There's huge population concentrations there, and so it's a great opportunity.
Yeah, New York
for
City is
retailers.
under retailed. Okay,
It is.
so if you had that my proverbial crystal ball, which I sometimes take an apple, and somebody came to you from, I mean, your company, you have a new investor from Italy, and they said, John, we're looking to buy. Where should we go? Okay, Bobby's told us multifamily. We love multifamily. Woody said, multifamily office buildings and everything else. Well, what would you recommend to these guys? Where's your outlook for 2007?
Well, in addition to prime midtown locations, I think that there's a lot of opportunity downtown, as Woody and I were talking about. Also, I think that within the midtown area, that the Penn Station Garment District area is an area.
The
that's
Herald
gonna have
Square, as we would call it.
Herald Square, you've got it. And in terms of opportunities outside of Manhattan, I think that there's definitely strong pockets of opportunity in Brooklyn, the Bronx, and Queens.
I think it really depends on your time horizon and the framework that you're looking at. If you're looking in the relatively short term, I think the areas that John pointed out are fantastic. There are still some areas that are not quite as chic as they could be or should be. But if you're looking at a long-term time horizon, we think the Bronx is a tremendous place to invest for the future.
I don't see Mr. Heller agreeing with you on that.
I was thinking about my answer, actually. So I'm not disagreeing with him. I mean, I think the Bronx is very good. I think that there's not a uniform...
When was the last time you were in the Bronx?
Well, we were selling a portfolio there, so I was there regularly on a weekly basis. But I think that our sense of the investor audience with respect to the Bronx was that some people didn't feel the demographics there were as strong as in some of the other outer boroughs today, but I personally don't agree with that, and I think that that's going to change. So I like the Bronx. But again, it depends your type of assets and your time horizon. My general answer to the question of where I would go today is I think that there's sort of a lot of different choices of things to do. If you buy into the argument, as John has been mentioning before, that we're in a space-constrained marketplace, and rents are going to continue to rise as a result, buying even in Midtown where prices are expensive is a very good deal.
Okay. Woody, it's hard to believe we're finished with time. I really think that my viewers have got a pretty good perspective on what they can project for 2007. I'd like to thank Woody Heller, Bob Knackel, and John Kaplan. See you next week when we talk about 421A changes.
Major funding for this program is made possible by grants from HSH Nordbank New York branch and First American Title Insurance Company of New York, Perfect Building Maintenance, Greenberg Traurig LP, the Moynihan Group. Additional funding for this program is made possible by grants from Antares Real Estate, Arbor Realty Trust, C.B. Richard Ellis, Cushman & Wakefield, Fremont Investment and Loan, Massey Knackel Realty Services, Muss Development LLC, Rosenthal & Rosenthal Inc., Signature Bank, Stonehenge Partners, Swig Equities, the Engel Berman Group, the Witkoff Group, Titan Capital, YL Real Estate Developers.